The idea of an AI bubble has become one of the most talked about topics in technology, finance, and business discussions today. To understand what an AI bubble really means, it helps to first understand what a bubble is in simple terms. A financial or economic bubble happens when people get extremely excited about something new, valuable, or revolutionary and start investing huge amounts of money into it, often much faster than the real value can justify. Prices rise not because the underlying product is already producing massive profits, but because everyone believes it will be incredibly valuable in the future. This belief attracts more investors, which pushes prices even higher, creating a cycle of hype. The concern with the AI bubble is that artificial intelligence, while undeniably powerful and transformative, may currently be receiving far more investment, attention, and valuation than it can realistically support in the short term. Artificial intelligence itself is not new. The concept has existed for decades, but recent breakthroughs in machine learning, large language models, and computing power have made AI far more capable and visible to the public. Tools that can write text, generate images, analyze data, drive cars, and automate tasks have made AI feel almost magical. Companies like OpenAI, Google, Microsoft, NVIDIA, and countless startups have positioned AI as the next major technological revolution. This excitement has caused investors, governments, and corporations to pour trillions of dollars into AI research, infrastructure, and startups. The belief driving this investment is that AI will reshape every industry, from healthcare and education to finance and entertainment. The bubble concern arises because expectations may be growing faster than reality. Many AI companies are valued at billions of dollars despite not generating significant profits. Investors are often betting on what AI might do in 5 or 10 years, rather than what it is doing today. This is similar to past bubbles, such as the dot-com bubble of the late 1990s, when internet companies with little revenue were valued extremely highly simply because they were internet companies. When expectations eventually collided with reality, many of those companies collapsed, even though the internet itself continued to grow and change the world. The lesson from history is that a bubble bursting does not mean that technology is useless. It means that hype and valuation temporarily got out of control. One of the biggest drivers of the AI bubble narrative is the massive inflow of capital. Venture capital firms, hedge funds, and large corporations are racing to invest in AI startups because no one wants to miss the next big thing. This fear of missing out, often called FOMO, can cause investors to make decisions based more on hype than careful analysis. When everyone believes AI is guaranteed to succeed, skepticism becomes rare, and risky investments are justified with optimistic assumptions. Companies sometimes exaggerate their use of AI, adding the label to products that are only marginally intelligent, simply to attract funding and attention. This further inflates the perception that AI is everywhere and unstoppable. Another reason people worry about an AI bubble is the gap between AI's promise and its current limitations. While AI systems are impressive, they are not truly intelligent in the human sense. They rely heavily on data, patterns, and probabilities, and they can make mistakes, hallucinate information, and struggle with reasoning outside their training. Many businesses adopting AI find that integration is expensive, complex, and slower than expected. The cost of training and running advanced AI models is extremely high, requiring massive computing power, energy consumption, and specialized hardware like GPUs. This raises questions about whether AI can be profitable at scale, especially for smaller companies. Despite these concerns, it is important to understand that calling something a bubble does not automatically mean it is fake or doomed. Often, bubbles form around real innovations that genuinely change the world. Railroads, electricity, automobiles, the internet, and smartphones all experienced periods of hype, overinvestment, and correction. After the initial excitement faded and weaker companies failed, the strongest players survived and built sustainable businesses. In the case of AI, even if a bubble exists, it does not mean artificial intelligence will disappear. Instead, it suggests that valuations, expectations, and timelines may need to adjust to reality. The media plays a significant role in amplifying the AI bubble. Headlines often present AI as either a miracle solution that will replace all jobs or a terrifying force that will destroy humanity. These extreme narratives attract attention but rarely reflect the nuanced truth. Sensational stories increase public interest, which feeds investor excitement, which in turn drives more coverage. This feedback loop can make AI seem larger and more immediate than it actually is. As a result, people may believe AI progress is faster and more complete than it truly is, contributing to unrealistic expectations. From an economic perspective, another concern is how concentrated AI investment has become. A small number of large tech companies control much of the AI infrastructure, data, and computing power. This creates high barriers to entry for smaller players and raises concerns about monopolies. If AI development becomes too centralized, innovation could slow, and the benefits may be unevenly distributed. Investors betting on smaller AI startups may find that many cannot compete with giants that have far greater resources. This dynamic increases the likelihood that many companies will fail, a common feature of bubble environments. At the same time, AI is already delivering real value in many areas. In healthcare, AI helps detect diseases earlier and analyze medical images. In finance, it improves fraud detection and risk analysis. In manufacturing, it optimizes supply chains and reduces waste. In creative fields, AI assists with design, writing, music, and video production. These real-world applications suggest that AI is not just hype. The challenge lies in separating realistic use cases from exaggerated promises. When expectations are grounded in what AI can actually deliver, investment becomes more sustainable. A key question is whether the current level of investment can be justified by future returns. AI requires enormous upfront costs, especially for data centers, chips, and energy. Companies like NVIDIA have benefited greatly because their hardware is essential for AI development, leading some analysts to argue that the real winners of the AI boom are infrastructure providers rather than application developers. If AI applications struggle to generate consistent revenue, investors may eventually shift their focus, causing a correction in valuations. This does not eliminate AI's value, but it reshapes who profits from it. The fear of an AI bubble also intersects with concerns about jobs and society. Many people worry that AI will replace human workers, leading to widespread unemployment. While AI will automate certain tasks, history suggests that technology often changes jobs rather than eliminating them entirely. New roles emerge as old ones evolve or disappear. However, the transition can be painful and uneven, which adds to public anxiety. This fear can further fuel hype, as AI is seen as both incredibly powerful and dangerously disruptive. Regulation is another factor influencing the AI bubble debate. Governments around the world are struggling to keep up with AI's rapid development. Unclear or inconsistent regulations create uncertainty for businesses and investors. On one hand, strict regulation could slow innovation and reduce profitability. On the other hand, lack of regulation could lead to misuse, ethical issues, and public backlash. How governments respond to AI will significantly impact whether current investments pay off or face setbacks. When people say AI bubble, they often imagine a dramatic collapse where everything falls apart overnight. In reality, bubbles usually deflate rather than explode. Investment slows, weaker companies shut down, and valuations drop to more reasonable levels. Strong companies with real products, revenue, and long-term vision survive and continue growing. If an AI bubble exists, its burst may simply mean a period of adjustment where expectations align more closely with reality. This can actually be healthy for the industry, forcing companies to focus on real value rather than hype. Understanding the AI bubble also requires understanding human psychology. Humans are naturally drawn to stories of rapid success and revolutionary change. When we see others making money or gaining influence, we want to participate. This herd behavior is a powerful force in markets. AI, with its futuristic appeal and visible demonstrations, is especially effective at capturing imagination. Recognizing this psychological element helps explain why bubbles form repeatedly throughout history, even when people are aware of past mistakes. In simple terms, the AI bubble debate is not about whether AI is real or useful. It is about timing, valuation, and expectations. AI is almost certainly going to remain a major part of the future, but not every AI company will succeed, and not every promise will be fulfilled as quickly as hoped. Investors, businesses, and individuals who understand this distinction are better positioned to make smart decisions. Blind optimism can be just as dangerous as excessive fear. In conclusion, the idea of an AI bubble reflects the tension between genuine technological progress and human tendency toward hype. Artificial intelligence is a powerful tool with the potential to transform society, but its current wave of investment may be running ahead of its immediate ability to deliver profits and solutions at scale. History shows that such periods are common with groundbreaking technologies. Whether or not we call it a bubble, the key lesson is to stay informed, skeptical, and realistic. AI's future is likely to be significant, but it will unfold through gradual improvement, correction, and adaptation rather than instant perfection. Understanding this helps viewers, investors, and everyday people navigate the excitement without falling victim to unrealistic expectations.